Hi, this is Stuart and welcome to the Investopoly podcast. My goal is to give you easy to understand, evidence-based, holistic insights to help you master the game of building wealth. And in my usual Wednesday episodes, I talk about the theories, methodologies, and principles associated with investing. The aim of these case study episodes is to share how it works out in real life by sharing a client story with you. But before I jump into that, just a little reminder that I have a 97-point financial health checklist that you can download. And if that's of interest, maybe check it out. The link to download that is in the show notes. So let's get into today's episode then. I'd like to share a story with you of how we worked with this client over the last 9 years, and he's more than doubled his investment assets, 2.2 times his investment assets. And I would say that actually his portfolio doesn't really reflect, all the work that we've done over that last 9 years. Some of the strategies haven't delivered the value that you would hope or expect. And of course, that's normal. Not everything delivers value at a straight line basis, but it's a good strategy to talk about because this client is in a really great position now as a result of the hard work that he's done over the last 9 years, of course, with our help. So we began working with him in mid 2015. At that stage, both clients were kind of in their mid to late 40s, and his net worth at that stage, or their net worth, I should say, at that stage was $2.7 million, which consisted of a family home worth $1.5 million, a holiday house that was worth $350,000. Male had some employee shares, so some shares related to the employer that he was working with. That was $180,000, and some super, which was worth $700,000. So really, the investment assets at that stage was about $880,000, mostly in super between husband and wife. Now their net worth is around about $6.5 million, so 2.7 in mid 15, 6.5 now. So of course now they're in their sort of late 50s, and that $6.5 million is really represented by, he's got about $2.5 million of equity in his home. Actually, what happened was they sold that previous home that they had when we met in mid 15 and decided to buy another house in a better location, bulldoze it and build. That was a really interesting and not so fun exercise for this client, unfortunately. So the property's worth 3.5, and he's got about $1 million worth of home loan debt against that asset, but was one of their big plans. And now they've built a family home that they're really happy with, they're in love with, in fact, in a better area. And it was one of their financial goals to do that. The holiday house has increased from $350,000 to $1.6 million. So some $1.1 million of equity over the last 9 years. That's kind of really good timing with respect to what happened during that COVID period, massive boom, but also the client completed some substantial renovations to that property. So it's not all just general growth in the market. They've got $630,000 of shares, which is mostly employee shares, still some employee shares, as well as some ETFs. I think there's about 160,000 of that 630 in ETFs. And we've got an investment property that we bought back in 2016 for about 1.2. That's worth about 1.5 now, so it hasn't really done that well, even though it's a great property. I'll talk about that in a second. There's about 1.3-ish worth of debt, so there's about $200,000 of equity there. And super's really gone very well, 2.15 million of super, so that's almost tripled over that period of time, so that's considerable. So really, if you look at the increase in net worth, I should say, over that time, which is about circa 3.8, $1 million's come from the home, 750 from the holiday home. So really, that they're two lifestyle assets. Then we've got about 100,000 equity in the investment property, 400 in shares, and just shy of $1.5 million in super. So we've got about $2 million in increase in investment assets and about 1.7 increase in lifestyle assets. So it kind of shows, I talk about, investing in the home. Last week I spoke about live investing in terms of a strategy of building the equity in the home and then using that equity to sort of fund or help assist in funding retirement. It's a important consideration because, as I said last week, there is some lifestyle elements and then some financial attributes that you want to take into account. The reality of the situation, of course, is what we want to do is build overall net worth worth, that gives us a sense of comfort and a sense of financial strength. And if push come to shove, they're the assets that we can utilize to sort of navigate through life. So these clients have a net worth of $6.5 million. Of course, they might have to make some really difficult decisions, but that $6.5 million is more than enough for them to be financially secure, almost irrespective of how it's split across the assets. I should say that, as I said, they have renovated the family home, and that's sucked out a lot of cash, like in terms of, the costs associated with doing that and then renting somewhere else while that's going on. And that was an extended period of time. So if we hadn't have done that, their financial position would be even more advanced than what it is today. And they've also gifted about $350 to one of their children, and they'll do the same to the other child as they get into the property market. So again, they've been in a really good position in order to do that. So when I reflect over the last sort of 9 years, what have we worked on? Well, we've made sure that super's working really well for them. They were in a couple of ordinary super funds, too higher fees, too lower returns. So that's worked out really well. We bought the investment property, of course, back in 2016. So it hasn't really done very much. Thanks very much, Melbourne. But it is a cracker of an investment property in a fantastic location that I would almost guarantee, in 10 or 20 years' time, it's going to really deliver exceptional capital growth. And we've navigated and assisted really around the home upgrade and build and had to sort of navigate everything that throws at us. We've advised around the divestment of the employee shares. So he's been allocated more and more employee shares, which we've sort of sold down, help fund, some of those rebuild, renovation, debt management, additional investments, contributions to super, all those sorts of things. And then, of course, advice around the investment allocation of surplus cash flow over that period of time. We updated the client's financial projections last year, and they plan to retire in 2028. So about 4 years' time. And the plan is to actually sell the investment property in sort of early 2040s. So let's draw a circle around 2040 to 2045. Some way down the track, we've still got another 20 years to sort of hold on to that property. And the role of that property is that the equity, the compounding capital growth that we'll enjoy over the next 20 years, will go towards replenishing superannuation at that particular time. So as I said, 20 years down the track. So a really comfortable position now, and certainly don't need to worry about money. Okay, as I like to do, I like to sort of reflect and say, well, what have we learned? What are the sort of key learning insights? What could we done better? What did we do so well? So let me talk about that. Well, of course, the property in Melbourne, the investment property, as I said, hasn't delivered much growth over the last 8 years, but its role isn't necessarily deliver returns in that 8-year period. Its role that in 30 years after we've bought it, when and if we need to divest of it to crystallize that equity, that equity is going to be there. And that's a really important point. Of course, it would be just better if it had have worked already, and we've seen some of that growth. But the whole point is we're making a 30-year investment decision, and therefore the asset that we buy is really critical with that, and the asset quality will certainly deliver those returns, in my view, over that 30-year period. So it's playing a really important piece of the puzzle, but we just need to keep our eye on that long-term outcome. The next observation, the holiday house, really perfect timing. I mean, it's improved their lifestyle a lot in terms of because they renovated and improved that property, but that COVID boom has been incredible. Now, of course, that's not going to continue. In fact, that market's a little bit softer today than it was, say, 1 or 2 years ago. And those markets, those beachside markets can have a lot more volatility than capital city markets, of course, but it's neither here nor there because the plan's never to sell it. The plan's to continue to use it. However, it's a great plan B. If everything sort of exploded, at least we've got that surplus asset we can sell down the track. The focus for the next few years is repaying the home loan debt, but it's really important that we've got a strategy around that, right? So when he decided to do the home upgrade, that was one of the key things. Okay, if we do this upgrade, how are we going to repay all this debt as well as still fund retirement? And that was a key element around, debt management and debt repayment strategy. It's something we've been able to help him with. It shows yet again, Super's played a big role here in terms of improving his overall net wealth. It's performed really well. He's had obviously contributions over that time, but it's really the returns that had a dramatic impact and will have an even more dramatic impact, say, over the next 4 or 5 years leading into retirement. So really low cost, high returns, that's the key thing here. I mentioned before that, the home loan bill did suck out a lot of cash flow over the last 2 or 3 years, as said, renting and debt management and so forth. So their position would be even stronger than it is today. And certainly the strategy to divest of these employee shares has been really good. And we were actually talking about this as a team today when we were reviewing our clients. It really is a strategy that we've employed for many clients, and I've never looked back and regretted it. So crystallizing, taking that money off the table and then reinvesting in a more diversified manner or contributing towards achieving some lifestyle goals. So overall, we could have done better maybe if we bought that investment property in 16 in Brisbane. If you had to spend 1.2 in Brisbane in 16, that's probably going to be worth almost $2 million today. But that wasn't the point. And I don't necessarily regret, even with the benefit of hindsight, regret that property acquisition as I said, a fantastic asset. He's bought well and it will certainly work. The last thing I want to finish on was, and this is something that it's very easy to overlook as someone that's very analytical, so very numbers driven. And it's really easy to sort of discount or underestimate the emotional impact and benefits of having a plan, having a financial advisor, working with a team of advisors, accountants, mortgage brokers, and so forth. And I'm sure a lot of advisors get these emails. So I'm not using this to promote my business. I don't need to remind anyone probably, but I very rarely talk about Pro Solution, the business, and what we do for clients and all those sorts of things. So this isn't to do that. It's just to highlight the personal impact of sometimes working with clients. And financial planning isn't really about investment returns. It's really about achieving financial and lifestyle goals. That's what people are going to remember, not really was the return 7 or 8%. In any case, this client wrote me an email back in May, and the email was just to say thank you that one of their children just got married, obviously had to pay for a wedding. And the client wrote, "We just wanted to thank you for all your Pro Solution team's work and financial guidance over the last 9 years. Financial position and confidence has helped make this very special day happen." So that is the wedding day, and he attached a photo of the day. So I wanted to mention that because it's really an important aspect or an outcome and very rewarding personally for me to receive an email. So I'm very grateful for the client to share those thoughts and those thanks. But I just wanted to draw it all in because I'm talking about this case study and we talk about the numbers and how the investments have performed and those sorts of things. But that's the other outcome, is that people feel empowered and they feel comfortable that they're heading in the right direction, and they've got a team behind them making sure that if there's any changes that need to be made, that we'll go and make those changes. And the thing that you'll see common in a lot of these case studies is it's not a single pronged approach. So sometimes super works, sometimes property works, sometimes shares work, and most of these case studies are over sort of 10-ish years. I've done some longer ones, 15, 17 years, whatever they might be. And over that longer period of time, you would expect, almost everything to work. But I think that's an important thing to note. If I fire 3 bullets, in the next 10 years, 2 are going to land. And over the next 20 years, all 3 will land, hopefully. But the point is that we're not single point sensitive into one particular strategy. Okay, that's enough for today's case study. Let's get into some really interesting listener questions. Okay, so the first question is from Rosemary. And Rosemary asks, "I wanted to please find out how franking credits are dealt with in a discretionary trust. I've Googled it, but I'm finding it a bit confusing. It would be great to have it explained simply." Well, Rosemary, I'll try and explain it simply. Essentially, if income comes through a family discretionary trust, it retains the original tax nature of that income. So if the trust receive interest income and then it distributes that to you, in your tax return, that will be recorded as interest income. If it's dividend income that's fully franked, it'll be dividend income, and so on and so forth. So it really flows through the trust and it doesn't actually change the taxable characteristics of that particular income. Franking credits are attached to a dividend, and so they must go to the same beneficiary. So I can distribute unfranked income to one beneficiary and then franked income to a separate beneficiary, but the franking credits must be attached to that franked income. You can't separate them. And essentially how franking credits work is that if I'm a listed company and I make $100 profit, as a listed company, I will pay 30% tax. So I'll pay $30 worth of tax. And so I've only got $70 then to pay out as a dividend. So I pay that out as a dividend into your trust. You actually receive $70 worth of cash. It hits your bank account, goes into the trust. The trustee decides, let's distribute that to Rosemary. The $70 goes into your account as a trust distribution. All along that trail, both in the trust and then when it gets distributed to you, attached to that are the franking credits, the $30 that the company already paid as tax, the corporate, the listed company. And so what will go into your tax return is that I received a fully franked dividend of $70 with $30 worth of franking credits attached. And so your taxable income, if you like, is the aggregate of those two amounts, so the $100. And so the ATO will look at your tax liability. If it's $100, of course, no one's going to pay tax on $100. Let's assume you've got no other income, but you've got these franking credits, so you will get a refund of $30 because ultimately that profit that that listed company has declared as a dividend has come down to you and you don't have any other taxable income. So essentially, it's not different to owning those shares in your personal name. And the reason it's not different is, as I said, the tax characteristics of a distribution from a discretionary family trust don't change. And I don't know if that's a simple explanation, but it's probably as best as I can do, Rosemary, and I hope that makes sense. Okay, and the next question is from Brad. Thanks so much for your question, Brad. Brad writes, as you know, we're avid listeners of your podcast. We continually go back and search for topics you've covered that may not have been relevant to us at the time, but have become so. And the reason I read out that part of the question from Brad, it's not really a question, it's a statement, is I just wanted to point out that if you go to the blog page on our website, the search function, which we improved last year, is actually really good. When I search for something that I've written, it's a really good search function. There's also an AI-powered search function, which will look at all the blogs and try and pull together a cohesive summary of those blogs. But if you are thinking about any particular topic, there's over 450 blogs on the website, and no wonder I feel tired. You know, that's almost really 10 books worth of information. So if you are ever looking for something, certainly go onto the website, use that search bar that is only on the blog page, and that'll search the blogs, and it's really a powerful tool. Anyway, let me read the remaining of Brad's question, which is a really good one. He writes, we find ourselves circling back to one topic in particular, the end game. We have taken some time to think about how to ask this question. The question is as follows. How do we transition the equity in our property portfolio into cash flow? In a fortunate position to be asset rich, but this is heavily reliant upon negative gearing. So we're committed to working full time. Our family is growing. We're experiencing more pull towards working less and creating a better work-life balance. The easy answer is to sell down assets and reduce debt to a point that it's more cash flow balanced. However, this goes against our long-term game principles. How do we keep our properties and utilize our equity position to replace our income? We understand the wonderful effect time, compounding capital growth, monetary inflation, and leveraging debt has on property, and would like to better understand the end game. Thank you for making your podcast more interactive. It's a real game changer. Well, thanks so much, Brad. It's a really great question, and I'm really pleased actually of how the question and answer sort of situation or addition to the podcast is going. I'm really enjoying answering the questions, and I hope you are enjoying asking them. So, look, the best way to answer your question, Brad, is that there's two ingredients to become financially free: time and your capital contribution towards the strategy. The less time that you have, the more capital you must contribute. The more time you have, the less capital you need, because you can just put that little seed capital in and let it grow and compound and let time do all the heavy lifting. Therefore, if you want to fast track your way to, having more flexibility on how much you work and work-life balance and those sorts of things, then ultimately you've got to contribute more capital, which essentially means more income. There's no magic bullet. There's no other way to do it. Now, many years ago, there was this strategy called living off equity. And the idea was that if you had a property portfolio of, say, $5 million and it's growing at 10% per annum, and I'm just going to use these numbers because they're round and easy. So that means the property portfolio is increasing by $500,000 each year, 10% of $5 million. If you're only spending, say, $100,000 a year, well, you can go and borrow that $100,000. You're still $400,000 better off. And this living off equity strategy became relatively popular. Now, it was pre-GFC, so it must have been, look, I want to say sort of 06, 05, sort of around that time. And there was even some mortgage managers that were trying to get into that space, talking to people. Borrowing to pay for living expenses, I think in some situations it might be okay, but it's just not my preferred way to build a strategy. And today is just not implementable from a borrowing capacity perspective and from a credit policy perspective. In today's environment, it's just not going to work. So, Brad, I guess what you need to do is get yourself into a position where all you're doing is just covering living expenses and the property portfolio's negative cash flow. You don't really need to, if you've already got quite a number of assets, you probably don't really need to be investing new capital, just really maintaining the portfolio. And, if you just think about it from a long-term perspective, a $2 million portfolio becomes $4 million after 10 years, $8 million after 20 years. That's $6 million of equity. That does all the heavy lifting. If you have more capital to contribute, so you say, well, okay, but I don't want to wait that time, you could invest in growth assets. And so one idea would be to go and build a sort of portfolio of liquid assets. So I'm really talking about shares, if you like, and use that as a way, build up a portfolio of that and use that as a way to not only fund living expenses, but then also fund property holding costs. So we're doing that for one client. So he's self-employed, will distribute a lot of profit into a corporate beneficiary. That means he'll only ever pay 25% in terms of tax. He's got a lot of gearing outside, against his property portfolio outside of those entities in personal names. We're not going to worry so much about debt reduction. Instead, we're going to put all that money into the market. We're going to build a portfolio. Maybe I don't have the projections in front of me. Maybe it's $3 million, $4 million in a few years' time, maybe 10 years' time, whatever it might be. And then the way we're going to look at that is to say, okay, well, if we drew, say, $200,000 a year, we'll spend $100,000 on living expenses and $100,000 towards managing the property's negative cash flow or something like that. A blog I wrote, I think last year or the year before, where I called it a third super fund. Kind of think of it like that as a pool of assets that are there to really fund that negative cash flow, that gearing. But unfortunately, you just need more time or more capital. Unfortunately, there's no magic bullet. It's probably not the answer you're looking for. I don't have a magic bullet there, but hopefully that sort of answers your question. Okay, next question is from David. He asks, if a couple, one high-income earner and one low-income earner, are both borrowing separately to invest in a diversified portfolio of passive ETFs, what are the considerations for deciding who should invest in Australian shares, franked income, higher dividend, versus who should invest in global shares, which are typically not non-franked, there's no tax credits, and lower dividends, to achieve the best outcomes as a couple? And it's a really good question, David. So thanks for asking it. If you look at the components of return from Australian shares, you're looking at, say, VAS, for example, as a Vanguard Australian Share ETF, which is the ASX 300. You are going to receive a income distribution from that investment of 4 to 5%, but it'll have 75 to 80% franked, which means franking credits. So not all of that is franked income, but 75 to 80%. So the grossed up pre-tax income yield on a VAS investments around about 6.5%. So if you're borrowing at 6 or 6.5%, which maybe today rates are slightly higher than that for investment borrowing, but long term they're going to be sort of around that mark, then you'll be neutrally geared, which means that your income will offset your deductions. There'll be no tax consequences associated with that. That's probably best then in the lower income earner's name. However, when you look at VGS, which is Vanguard's international ETF, over the last 5 years, the income was 2.7% and 10% growth. Mainly driven by the US share market, which I'll discuss tomorrow in more detail. And so you could be negatively geared in that situation. Obviously, if your borrowing interest rate is more than 2.7%, which inevitably will be, you'll be negatively geared. And that'll be in the highest income earner's name, because that makes sense, because they're going to enjoy the tax benefits, hopefully at 47%. Now, the downside to doing that is that you've got a lot of growth in typically, less income, more growth. You're not going to get 10% long term. That's what it's been over the last 5 years, but it's not going to remain at that level long term. You're going to get more growth, which means you're going to have higher unrealized capital gains in one person's name. Ordinarily, that wouldn't be perfect, but assuming that you could hold those investments for the long term and you wouldn't need to sell any of them until you get into retirement, then I'm not too bothered by it. Because one of the benefits of share investing, of course, is you can progressively sell down. So if you've got this big portfolio, you can sell $50,000 of the portfolio, 100,000, whatever it might be, per annum, and you're going to spread that capital gains tax liability over many tax years. It should be relatively easy to navigate. So yeah, Aussie shares in lower income earners name, international shares in higher income earners name works really well. Similarly, if I have a portfolio, and I think I've talked about this before, if I have a portfolio, some outside super, some inside super, I'll typically put the international inside super just because I've got that compounding capital growth. And if I get into pension phase, I'm not going to pay any tax on that unrealized gain. And then Australian equities outside super because I've got the imputation credit. So it alleviates the ongoing tax liabilities associated with that. So you can think about it as a inside-outside super structure and also a husband-wife sort of or partner-partner structure from a taxation perspective. But great question, David, and thanks for asking it. Okay, I'm conscious of time. I'm going to leave it there. And until tomorrow, bye for now.